What's up, everyone? Welcome back to the Outlier community, where profitability is the name of the game. Today, we're going to be talking about trading plans, strategy outlines, and trading logs. This is a topic I am intimately passionate about because I truly believe this is where I have derived my personal edge in trading. I've been doing this for over 15 years. I have not come up with any sort of super fancy system that always works 95% of the time, like you're going to hear all over the place. What I have learned, especially as impressed by my mentor, is good money management and portfolio management. The name of the game is trading plans, strategy outlines, and trading logs. So my goal for this video is to run through a quick overview of each because I have varying videos going further into detail, so I don't want to beat the point too far. But what I want to do is combine those overviews with practical construction. So I have a sample trading plan that I literally just made right now for the video. Same thing for a sample trading log. And my goal is to make something that's presentable, easy for people to follow along, to get the idea in case you're trying to find different things to include in your own. So let's dive straight in and get to it. So trade plan, strategy outlines, trade logs, what are they? I reference these three documents all the time. To me, these are the primary components of trader documentation. So trade plan is an overarching document that lists everything that you are expecting to deploy into the marketplace. We'll get into that in a minute. Strategy outlines, in my opinion, are a subset of your trading plans. They're going to live within that, but that is a detailed overview of individual strategies that you are seeking to deploy. And then the last one is your trading log. Your trade logs should support your trade plans and your strategy outlines. So this is a way for us to quantify and track qualitative data as well, real time, and then we can conduct historic overview of them to make informed decisions going forward. So let's take a look at why do we do this? What's the purpose of the trading plan, strategy outlines, trade logs? Why? It is this right here. We are, one, forcing ourselves to preemptively think through how we anticipate deploying. One of the worst possible times to try to figure out complex problems is when things are not going well and you're trying to figure it out on the fly. We have emotions running rampant. Conditions are rapidly changing, so we're not able to adjust as quickly as we need. And we're not getting the best version of ourselves. It's the same reason in the military that we have things called SOPs, standard operating procedures. This doesn't give you the answer to every single environment, every single scenario that you're going to run into throughout your entire military career. What it does, though, is it looks at historic instances and says, in this kind of problem, these are some of the things that worked, or this is how we expect to do things. It gives you a baseline to work off of. That is the nutshell here. If we think that our trading plans, strategy outlines, trade logs are going to be 100% always mechanical, unfortunately, you're going to be sadly mistaken. I would argue they can get you to 90, 95%, but the trader always has the last say because we need to be able to perceive the environment and make the best possible choice. There so far is no perpetual plan that is purely systematic that always works. And because as soon as there is, everybody's going to do it, myself included. And there's a reason why it's not there yet, because the markets are too dynamic. There's too many inputs. It's not to say we'll never get there, we're just not there yet. So by creating this trading documentation, you give yourself a way to follow a systematic process and remove some of the variability in your market deployment. The markets have a ton, really an unlimited number of variables that are included into it on every single day. Now, what we need to limit is us as an additional variable. We have to control ourselves, because if you're trying to optimize, if you're trying to refine a plan that you're hoping you can turn into a successful strategy long term, It's not going to work super efficiently if you're just winging it and try to remember what you did last Thursday and what conditions were present and how you felt. You need to come up with a little more of a systematic process. So there's a little bit of legwork up front in getting these things set up, but once you do that, they're actually relatively easy to maintain. So what are the components of a trading plan? We'll start with that, then we'll go into the strategy outlines, and then we'll go trading logs at the end. So your trading plan. So I like to split mine up into these three main sections. Obviously, the purpose of the trading plan is it's going to be very personal to you. But my goal with this is to give you some ideas to either integrate into your existing trading plan, or if you're struggling figuring out how to even start one, start here. So I like to begin with my portfolio management section, then an analysis section, and then my individual strategy outlines. So in the portfolio management section, I'm going to look at things like the goals for the portfolio. What is it that I'm even trying to achieve? How am I going to measure those goals, assess my performance to make sure that I'm moving in the right direction? Those kinds of things. I also like to outline what time frame this entire portfolio is being utilized in. That's actually why the channel is called esInvests, because although I'm primarily a trader, I'm trading really with an investing mindset for the longer term. I'm using it for income now, but you get the point. Then I like to make sure I have a specific section on risk. How do I feel about risk? What do I assume I'm comfortable with? That's going to be something you need to confirm or deny. And then also, what are my plans for utilization? How much of my portfolio am I going to use when? Things like that. We'll get into an example in just a minute. Then I like to have a specific section for analysis. The way that I think about the analysis section of the trading plan is this is kind of like a repository. This is where I'm going to list out all of the tools that I think I'm going to use and however I expect to use them. And then I will reference the specific analysis in the strategy outlines as I want. But by creating this overall analysis section, it does a few things. Notice how I list out fundamental analysis, technical analysis. You can Google all of these things. You don't necessarily have to put them in your trading plan, but the reason why I like to put them in the trading plan is it forces you to go through that added step. It's just like you did in high school where you took notes. It's the same exact thing. You start to develop a further understanding because one of the things, and again, you'll see this in the sample trading plan, but I like to include things like the formulas. This forces me to understand what a PE ratio actually is and how to use it. Same thing when we're talking about revenue, things like that. And then screening. I have a ton of screening in the strategy outlines, but I also use them, or I use kind of like a broader screening bucket in the broader analysis section, because these are things that I require of anything I'm going to trade. Things like liquidity. That needs to exist if I'm trading a covered call, if I'm trading short puts, if I'm even trading long stock. So what I think about in the screening for the analysis section is what things apply to anything I'm going to touch. What are the things that I need to look at no matter what trade I'm putting on? Corporate actions is a great example. If I'm trading any strategy, no matter what the strategy is, even if I'm buying stock, if there's corporate action in 2 weeks, that still matters to me. So that is why I list those kinds of things there. And then the last one, the strategy outlines. This is a really just intimate section of the trading plans because it forces you to dive into deep detail on your individual strategies that you expect to deploy. So for the strategy outlines, let's say that this is a covered call that we're outlining for this one. I'm going to list out an executive summary for that. I'm going to talk about what I'm looking for, how I'm going to set this trade up, what conditions need to be met, how I intend to manage the trade throughout its lifespan, and then any RFIs, requests for information in the military, we would call it, or tracking components. So RFIs are things, if you're first starting out or if you're refining your strategy, you might not have all the answers. You're not going to have all the answers. So this is where you can come up with some guesses, assumptions that you then confirm or deny and then optimize as you increase your data set. So this might look like a lot. It can be overwhelming, but there's a couple things that I want everybody to keep in mind. We're looking for progress, not perfection. You're not expected to have all the answers. I absolutely didn't when I first started, and I'm still refining my training plan now. I talk about it pretty frequently, but I literally edit it probably weekly with small little details, adding in new information, adding new reference articles, stuff like that. We already talked about the idea of making assumptions. You have to be comfortable operating in ambiguity. That extends to your trading plan. One of the biggest and most detrimental hurdles I see is somebody's looking to trade in the markets. They don't really know how they want to do it, so they're not comfortable writing it out, but they're comfortable just winging it by putting a trade on and seeing how it goes. It doesn't make sense. But people do it all the time because the process of forcing yourself to write out a trading plan is uncomfortable because you come to terms with how little you might know about something or how many questions you still have, even though you might be pretty proficient. So it's okay. Be comfortable, accept the fact that you're going to be working in an ambiguous environment, and that's okay. But you need to make sure that you are tracking those assumptions, you're tracking those questions so that you can answer them. And as you answer them, I think it's really helpful to track the revisions you are making to your trading plan. It helps you understand how your thought process is evolving over time. And then as you're testing different strategies, you can see what kind of things really matter to you and what things didn't matter to you so much, and use that to grow. So for a quick example, this is an older version of my trading plan. But anyways, I just want to give you guys an idea of how I like to deploy it. So I have this big old section up front, and I like to use the table of contents. So then I can just, click over to whatever I want. So let's say if I want to learn about the earnings per share growth, I can just jump over to that. So you don't have to have like a several hundred page trading plan like I do. I've developed that literally over 15 years. What you can do instead is something like this. This is just to get you started. So I'm going to zoom this in just a little bit, and I want to walk through this example trading plan just to give you guys some ideas. So notice how I maintain the same approach. I still use a table of contents. Let me make sure this is all up to date so that it's easy to navigate. But then more importantly, as you add things and as it does inevitably grow, you're able to more efficiently navigate it because they can become unwieldy, especially when they're longer documents, as they should be. So let's take a look at a few things. Let's say we have this, let me move this over here so that you can see, I just want to see the outline as we're going through it. So we have this portfolio management section. So that's the first thing I have. And then goals, I put purpose and objectives. So let's jump down there and we're going to work through this in order very quickly. So first off, I think it's really important to quantify what you're trying to do. I've talked about my goal for some time. For a long time, my goal was to achieve at least 15% per year. So there it is. Now, if you're not sure, if whatever your goal is, take a guess. Maybe outline a couple things that you want to do. If you're a new trader, something like be positive at the end of your first trading year. It's a fantastic goal. So outline all of your objectives, but make sure that they are things that are specific, measurable, realistic, and time-bound. It's kind of like SMART instead of SMART. You can use the SMART framework if you're so inclined. It just adds achievable, but I just kind of use realistic for the R. So anyways, whatever goals you have, outline them. And this, again, it's really difficult for people to even go through this process. They're more comfortable just starting to trade because it's easier. But once you have a little bit of more fidelity on what you're even trying to achieve, you can craft a better thought process to get there. Next up, time frame. Same thing, just, how are you going to manage your money, your portfolio across different time frames? If you're using partial income, where are you going to put that money? Things like that. Then risk approach. This is a slightly more in-depth section that talks about in detail your approach to risk. What are you comfortable with? What are you uncomfortable with? How do you intend to manage your portfolio? What drawdowns in your portfolio are you okay with? What variants of that are you okay with? If there's a huge drawdown, what will you do? This is where you can start to postulate different environments, different scenarios, and again, make assumptions on how you want to act. I know this might seem like, man, this is a lot. You don't have to have all the answers up front. But if you don't get to this level of fidelity over time, it's a mistake. I truly think that. You're going to find pretty much most successful traders are either going to have some written version of this, or they're going to have a really robust trading plan in their mind. I don't necessarily use my trading plan when I'm deploying every single trade. But again, one of the primary exercises and utilities of it is to be able to reference it, or the actual act of building it is very useful. So this is my risk approach. One of the things that I talk about a lot is I like to split my portfolio into core and speculative allocations. Core, the way I view that, and you can define it here if you want, this is how I'm really expecting to hit that 15% per year. I am going to talk about what products, what strategies, what utilization, how I'm going to manage risk in the core allocation. And then speculative allocation. This is where I see a certain market condition that I'm interested in. I want to take a shot. HUT, the current Leaps HUT diagonal that I have on, is a perfect example of a speculative trade. It's, a hunch. I think Bitcoin is going to go up over the course of the next year. So I put on a bullish trade in Bitcoin, and that falls into my speculative allocation. Same thing. I'm going to outline what kind of things I'm looking for. Now, you can also call out some specifics in terms of general risk management practices like this. No single position will exceed 10% of my portfolio unless it's an index ETF. If you're a new trader, maybe 10% is too high. 5% might be a better number. Again, this is just to give you all some ideas on things you can include, some detail that's helpful to add, and then you can see whether it's useful to you. You don't have to keep all of it. Next up, utilization. How are you going to deploy your portfolio? What kind of conditions are you going to look at? Are you going to base your portfolio utilization off of VIX levels, off of where the S&P 500 is, off of recent highs, off of current macroeconomic indicators? There's a ton of different things you can use. I think a great starting point is basing your utilization off of something like the VIX. It can give you some ideas on how volatile the market is. And if you want to take advantage of the volatility, maybe you scale in when the VIX is higher. But maybe if you're trying to reduce variance in your portfolio when the VIX is higher, you actually scale out a little bit. There's different ways you can approach it, and it's going to be really dependent on you, the trader. But that I find the VIX to be useful because it can apply to any portfolio. You just take a different look at it. All right, let's talk about analysis. So fundamental analysis, technical analysis, pretty straightforward. I like to list out all of the tools, how they're calculated, how to use them, some of the ins and outs of, fundamental analysis, for example, a lot of the indicators that should be compared within industry as compared to as a raw number, little things like that. And you can include everything that you ever come across here, and then you can just reference the ones that you use the most. Same thing for technical analysis. Now, for screening protocols, this is exactly what I was outlining before. This is where I like to take a look at things that are very specific. And they apply, though, to all of my trades. Things like liquidity, corporate events. If I'm trading options, it needs to have weeklies. I'm always going to look at the IV percentile no matter what I'm trading, those kinds of things. This can be really helpful, again, just to give you a simple process that you can continually follow and modify. This is also a great place to include something like a trading checklist if you're deploying that kind of thing early on, wanting to make sure you hit all the necessary things. The important part, though, for screening protocols, trading checklists, is to make sure that it's palatable. If you make it so long and arduous because you're trying to be really comprehensive, but you don't use it, it's useless. So you got to find that balance between the right level of information and then something that's useful. So the last thing I want to talk about in this video is the strategy outline. And in here, so for the strategy, again, let's say, this was for a covered call. I like to include an executive summary up front. The reason why I like to include an executive summary is because it really forces you to have a certain level of understanding of what it is you're summarizing. It's very difficult to be succinct about something if you don't know much about it. So that's exactly the purpose of the executive summary. The setup. So I like to split up the strategy outline again into these segments. So the setup is what kind of conditions are you looking for? What products are you looking for? What specific screening criteria are you using? What fundamental analysis applies here? What technical analysis applies here? How are you going to allocate money to the trade? How are you going to scale into the trade over the life cycle of it? What's your initial outlay going to be? So if I'm going to allocate $100,000 to a trade, I'm going to enter with up to $30,000. It gives me $70,000 left that I'm still going to apply to the trade. It's allocated to it, but it's not utilized yet. So coming up with an idea on how you want to use that additional $70,000 that you have allocated to the trade, those kinds of things. And then you'll notice an important note here that I have max risk outlined. You're going to talk about risk a couple times in your trading plan, or I'm sorry, in your strategy outlines. And that's because risk is really freaking important. But for max risk, I like to outline in the setup what is the no shit max risk that I will allow for that individual trade. There might be slight nuances. For example, if I'm trading a leaps call diagonal and it's a speculative strategy or a speculative trade compared to a core strategy, in those two scenarios, I'm going to have a different max risk. But what I am going to do in my strategy outline is outline what my max risk would be for the core and the speculative. So for example, the Hut leaps diagonal trade, the max risk I have in that trade is the total trade allocation. I purposely am using the entire amount that I've allocated to the trade to control my overall risk. I will not add more beyond what I'm establishing in that trade. So that's one example on max risk. If you like to use a percentage down move from current levels, 8% is really common. You can outline something like that. But again, you can always say, I'm not sure. I'm going to try this and see how it works, see how it goes. Maybe paper trade a little bit, document it, and then come back and update. Management. This is pretty self-explanatory, but again, this is forcing you to think through different scenarios before it happens, before you even put the trade on. This is so that you are not taken aback when things start moving sideways. This isn't always going to be the perfect solution, but it gives you a foundation to base different decisions as markets move. So how are you going to control risk? When? What amount of risk? Are you going to pare down a losing trade? Are you going to completely exit a losing trade? This is where you need to start thinking about your expectancy calculations to make sure that it makes sense when you're managing both risk and profit. So I think this is a great section to dovetail over to expectancy. If you're unfamiliar with it, I'll link to it up here. But this is exactly where you want to come up with those decisions ahead of time. And if you're not sure, paper trade it, see what works, see what has positive expectancy, and then deploy it. Same thing for adjustments. When are you going to adjust the trade? When are you going to scale into the trade like we were talking about here? What kind of things do you like to look for? So for example, if I'm trading short puts and they're cash secured puts, if I see a 5% move in the underlying down or up, I'm going to analyze. What that means is I might scale in either way, or I might scale out. But I use that 5% move as a trigger for me to apply a decision point. You can use something like that. Again, whatever, if you use support and resistance levels, you can use those. But the idea is to outline, again, whatever it is that you think you're going to do to manage the trade and analyze when you should manage a trade, see how that works, document what you think you're going to do, and then see how it pans out. Maybe it's a good plan, maybe it's not. But what you're doing is you're giving yourself clear, definitive information to base and assess proficiency and then adjust as needed. All right, Rfis and tracking. So we already talked a little bit about, when you're making an assumption for some of these other sections, but there's two things I want to highlight here specifically. When we're trying to optimize a strategy, it is helpful to list out the question or the way that you're thinking you're going to optimize and clearly define how you want to track it. So for example, let's say that you're only going to enter a bullish trade when the 9-day moving average crosses above the 21-day moving average. Okay, so now we track that in this strategy and see what the results are. See if that makes sense. Maybe it doesn't give you enough trades for your original expectancy to make sense. So maybe this doesn't work. Maybe it does work. but it gives you, again, a space to very clearly define what you're trying to do and then track it. Now, speaking of tracking, I think that it is really important for this section down here, which is how you're going to build your trade log, which will be a follow-on video. So when we're thinking about tracking, we need to list out for that strategy what details are important, because that's what you're going to track in your trading log. So if I'm trading short puts, the delta matters a lot. The days to expiration matters a lot. The implied volatility percentile matters a lot. Rho does not matter so much if it's a shorter term trade. So what I like to do is think about everything that you think might matter, over track up front, and then cut the things out that you don't need. But I definitely think having too much information up front is actually helpful in this scenario, provided you're going to stick with it and continue to input the data, and then you'll have a more holistic understanding of what really does matter as you get more experience with that strategy. So that's a sample strategy outline. I have a couple of them when in my options 301 playlist where I walk through essentially this, and it helps me understand how I'm going to deploy a strategy definitively. So that really is the whole purpose of the trading plan and the trade logs. It gives us information. It gives us a way to base decisions and assess performance. If you have any questions on trading plans or trading logs, throw them in the comments. And most importantly, I have a question for you all. If there's something that you have found really useful or something you've just struggled with as it pertains to trading plans and strategy outlines, throw it in the comments. Share that with the rest of the community, because again, the hive mind can be very powerful and I want to tap into that. So the next video I'm going to do is on trading logs, because this one's already 26 minutes long. And the idea is both of these together will create a fairly comprehensive trading documentation plan for you all to launch off of and make it your own. So don't sleep on the work that needs to go into this stuff. I know it sounds like a lot, and it should sound like a lot, because if you truly want to be successful, you got to be an outlier. If you want to be an outlier, you got to put in the work. So that's what this is. I hope everybody has a great rest of their day. Thanks for stopping by. Make sure you subscribe if you find this stuff helpful, and I will catch you all later.